So let's discuss the markets as well as sectoral picks with Nikhil Khandelwal. He's the Managing Director of Systematix Shares and Stocks. Good evening, Nikhil. Welcome to the show. Before I hand it over to Ajay, just give us a quick perspective of where do you think our markets are headed. The rest of the world, we're seeing the equity markets headed higher. I would imagine our markets are no different.
Yes, see, markets today is close to trading at close to about 18 times odd of FY18 earnings, which is at a record high. Obviously, we are estimating that FY18 earnings growth will be close to between 15 and 20%. With of course demonetization has reduced the base for FY17. But assuming that even 15 to 20% earnings growth is there in FY18, and 18 to 20 times PE for the market is of course one of the highest in the global market. So given the levels the market is in, there is definitely going to be profit booking, and we expect the market to remain range bound from here on.
What are your thoughts on the earning estimates? A lot of brokerages now on the street have started reworking their own numbers. By your own estimate, what kind of numbers can we put out for 1 year forward in terms of Sensex or Nifty EPS, and are you taking a relook as well like many others?
See, we didn't correct the earnings estimate right after demonetization. I think we were all on analysis mode, trying to understand what's happening in the things on the ground. Clearly, November was a month of a lot of corrections. The stockists were busy liquidating the material which they had, and companies were obviously themselves analyzing the level of inventories which are sitting in the system, etc. I think December we kind of gained some stability, but January onwards I think things have come up across the consumer products ecosystem. Things have come up fairly strong. The recovery has been much stronger than even some of the corporates' own estimate. Net across the board now, post Q3 results, we have seen maybe earnings downgrade across the board, including industrials, companies, maybe a maximum about 5% or so. But on the consumer businesses, I think we are while we may end up maybe 2-3% below estimates to flat on our estimates, but on FY18 basis actually we are actually beginning to upgrade our estimates. So the consumer demand growth across as I said, across the ecosystem, whether it's two-wheelers, four-wheelers, staples, and various other product categories, has been fairly strong. So FY18 we are actually in the midst of upgrading our estimates.
Nikhil, you guys at Systematix are very stock specific guys and have actually produced some really good multi-baggers on the mid-cap side and good returns from the large cap ones. At the current juncture, what are the top sectors you're analyzing or going through, and particularly specific stocks which are looking attractive for a reasonable return period?
Yes, see, we are post demonetization. I think we have started seeing certain inherent changes in how how the market structurally has started changing, and one of the things which we have seen and we are analyzing very closely is the coming of the formal banking system to the forefront, and post demonetization the sheer amount of money which has come back into the banking channels through SMEs, through individuals, whether it's rural, urban, market put together, it's been unprecedented. So the banks actually were not formally there accessing these kind of customers, and hence there was a huge opportunity which was open for the NBFCs to tap into. So we believe the banks which are more agile and more focused on the SME base as well as the individual lending would tend to benefit more in this phase of the market. So small finance banks, according to us, like the Ujjivan, then the Equitas, as well as some of the private banks which are focused on this segment, like the Yes Bank, the RBLs or the DCBs, etc., would be, according to us, some of the major beneficiaries of this phase of consumer ecosystem, as well as the market growth itself. Second segment, which we are tracking closely, is the rural market driven consumer growth itself, and within that we are seeing a lot of growth on the entry level products, whether it's the staples, consumer staples growth, as well as entry level two-wheelers and four-wheeler demand. So we believe some of the companies which are very strong in that segment of the market, whether it's the ITCs or the Britannias, in the two-wheeler side, Hero, Honda, TVS and Maruti, etc., would tend to benefit the most.
So you like NBFCs, you like small finances, you like sectorals which have a rural focus, especially like things like two-wheelers, anything like that. But what are the sectors you would recommend, Nikhil, that one should exit, should avoid, should book profit in?
Yeah, see, we would be basically recommending clients to book profits or partially exit businesses which probably won't see secular earnings momentum, and we believe that certain businesses in the metals and mining business, they may not be able to continue on their earnings momentum, and they probably have run up sharply ahead of their their earnings. So we are basically recommending some exits within the metals and mining universe. Also, another segment of the market wherein wherein there are worries is on the pharma side. And within that there have been certain pharmaceutical businesses which are continuing to show pain as far as volume growth in the US market, or predictable launches in the global markets. So we are also recommending exits from pharmaceutical businesses which are actually unable to continue on innovating enough as far as the product engine in the global markets is concerned, because over a period of next 3 to 4 years, if you are not there in the specialty categories in the pharmaceutical market, you would tend to miss out on what actual value a US market can generate, and it's a declining trend on prices as well as volumes for generics. So companies which are primarily focused on specialty and building a sustainable book, we are recommending clients to remain invested in those and exit the non-specialty category companies.
Okay, so those are the sectors that you are recommending to stay far away from. Now, at the start of the interview, you did mention that you expect the markets to remain range bound. However, you are expecting the new financial year for the earnings to see an upside of maybe up to 15 to 18%. What would you say are the risks to the rally that we're seeing at the moment? Will it be earnings only if they don't pan out the way you're suggesting?
Yeah, I think the biggest risk to the market is the earnings growth itself. I think the UP elections or any elections for that matter would only be kind of reflective of the mandate to the Modi Prime Minister Modi in that particular state. I don't think that really impacts the earnings of businesses per se, so those will be temporary blip, possibly opportunities to buy, add more into businesses you like, but I think the real dent which can actually happen to the market is possibly a dent on the earnings growth itself, and especially I think the consumer set of businesses, which is what the Indian market is centered around. I think the another risk which we are prone to is of course from the global market side, wherein the US market is going through its own structural changes. So unless something very some very knee-jerk decisions are taken by the US Senate, or whether it's on the IT side or on the pharma side, I think those are going to be the events to track as we move forward from a market point of view.
Okay, we're going to leave it at that. Thank you so much for joining us on the show, Nikhil, with your outlook on the markets, the sectoral bets, and the ones that one should book profits from. We'll get you back on the channel soon with your outlook. Moving on away and a little bit away from the markets, the GST Council has proposed to raise the peak tax rate to 20% versus the current 14%.